Hello, guys. Hello, guys. I hope you're good. I hope you're good. Thank you for waiting, guys. Thank you for patience. So today we're doing revision, accounting, grade 12, it's companies. So today we'll be doing the statement of financial position, the statements of comprehensive income, a little bit of depreciation here and there, and we'll do also fixed assets. So I want to. So this is the question paper we'll be doing today. It's November 2022, paper one. So guys, if you can hear me, can you please react with a thumbs up? If you can hear me, please react with a thumbs up if you can hear me very. Okay. Okay, I got a thumbs up from Kagiso. What's happening? Some of you cannot hear me, guys. Guys, I only have, okay. It's a thumbs up from Kagiso. What's happening with some of you? You cannot hear me. So, okay, guys, can you please give me a thumbs up if you can see the question paper very clearly? Okay, guys. So this is how the lesson is going to go. So if you have a question, you want to ask something, you're gonna use the emoji to raise your hand, and then you're gonna unmute your mic. I'm gonna mute mine. You're gonna unmute yours, and then you say you ask a question, and then we do that question. And if you cannot hear me very well, just use an emoji, raise your hand, and then you unmute your mic, and then you say you cannot hear me, or I was fast a little bit there and there. So, guys, today we're doing, as I said, companies. So we'll start with company financial statement, statement of comprehensive income, and the statement of financial position. So it says here on the question, it says the information relates to Lyson Ltd for the financial year ended on 28 February 2022. So as we all know, as accounting students, as soon as you see, as soon as you see your year end, you must write down when it started. So it said 2022, February 28. That's when it ended. So meaning it started March. It started March. It started March March, April, May, June, July, August, September, October, November, December, January, February. So this is 2-2 and this is 2-1. This is 2021 and that's 2022. So let's go back to our question. Let's see. And then our first question was refer to information B, calculate the cost of the closing, the cost of the stock that was damaged. So we have to go to information B, guys, and calculate the cost of the stock that was damaged. So here is our information B, and then they say stock records, and then they say the business sells sports shares. The weighted average method is used to value the shares. The following information was extracted from the records. So as we all know, we have quite a few quite a few methods to value the stock. So we have FIFO, which is first in, first out. And then we have weighted average. We have weighted average. We have weighted average, and then we have specific method. So in this case, they only asked us about weighted average. So how do we do weighted average? This is how you do weighted average. And then they said we must, in this business, uses weighted average to value their stock. So the first thing we have to do, we have to calculate the weighted average price. So we have to calculate the weighted average price. How do you do that? The weighted average price, you say opening stock plus purchases plus net purchases. I want to write net purchases because of I don't have enough space for purchases minus returns. So I'll just write net purchases. So plus net purchases all over, which is opening stock units plus net P units. So that's how you calculate your weighted average price. So in this case, our opening stock in terms of rent value, it's 1,200,000. So we have 1,254,000 as our opening stock. We don't have returns. We have purchases for during the year. And then our purchases are 5,325,000. So we have 5,325,000 all over. And then we have to check how many units. 1.9 units. 1.9 units plus 7,100 units. So guys, are you still with me? Can I have thumbs up, please, if you're still with me? If you're still with me. Okay. So you can see on this activity, it's already easy because of they did add our opening stock plus our purchases, and they did give us a total, which is a total of 6,579,000. So we'll say 6,579,000 divided by the total units of the opening stock plus the purchases, which is 9,000. And then our weighted average price will be 731. So this is the weighted average price. This is the price you will use, you will multiply when you're calculating closing stock and when you're calculating missing stock or stock damage. So let's go back to our question. So our question was, we have to calculate the cost of the stock that was damaged. So the first thing we have to check is how many shirts did we have available? How many did we sell? And how many are we left with? And then in all of that, in all of that, we have to check the balance that is left, meaning the balance that is left is are the shirts that are damaged. So the first thing you have to do, because of in this activity, they already added your opening stock and your purchases. The first thing you have to do, you have to say 9,000 rand, 9,000 units minus, we start by what we sold, minus what we sold, which is 7,750, minus our closing stock, which is 1,185, equals to, let's see how many how many shirts were damaged. So we have 70 shirts that are damaged. We have 70 shirts that are damaged. So now, because of now we have the number of units, the number of shirts that are damaged, and we also have the weighted average price, we can simply say our, we can simply say our units times the weighted average price. And this will give us a weighted average price. And this will give us the cost of damaged goods. Go back. Oh, it's 185. It's not 180. I made a mistake, guys. It's 185. It's so it's not gonna be 70. It's gonna be 65. 65. 65. It's not 70. I punched the wrong digits on my calculator. So it's gonna be 65, meaning here it's supposed to be 65. Here is gonna be 65 times 730 times 731, which is 47,515. Are you still with me, guys? Are you still with me, guys? Can I have thumbs ups, please, if you're still here? So let's go to our second question. Our second question says, refer to information B, Roman figure 2. Calculate, we have 1.2.1, the profit or loss on sale of a delivery vehicle. And then we have 1.2.2, the total depreciation for the year. Obviously, as an accounting learner, immediately when they talk about loss or sale of assets and depreciation, your mind, you have to think about fixed assets and you have to think about asset disposal. And then you have to come up with the fastest way to get to the answer, because of, remember, you are also fighting against time. 2 hours is not enough. So we have to go to our transaction and see what's happening. So the question says we have to calculate the profit or loss on sale on the delivery vehicle. So here we have our transaction. It says vehicles are depreciated at 20% per annum on diminishing balance method. So we have vehicles, and then they say an old vehicle with a carrying value of 170,000 on 1 March 2021 was sold for 140,000 on 1 December 2021. So guys, for this transaction, I'm gonna need a bigger space. I'm gonna need a bigger space. So listen here, guys. So as you all know, we have two methods to calculate depreciation. We have the cost method and the diminishing balance method. So we have the cost and the diminishing balance method. So this is what I want you to remember during an exam. So cost method and diminishing method, diminishing balance method. So the cost method will always say, its formula will always say cost times rate over 100 times time over 12. So for the cost method, the depreciation is very straightforward because of the only thing you need is the cost, which will be given, the rate, which will be given, and then when you'll have to use your calendar, your financial year calendar, to calculate the time, which is one thing you have to focus when you focus on when you do depreciation. You have to make sure that you understand when was it bought, when was it sold. So when you're doing cost method, you don't have to worry about the cost of the asset, because you'll be given the cost of the asset, you'll be given the rate of the asset. But the the only thing you'll have to calculate is the time. So once you get your financial year calendar, once you master that, you know very well good. Oh, it was bought on 1 August, so I'll start calculating from 1 August. It was bought on the 31st of August, so I'll start calculating from September. But oh, you know, okay, it was sold on 1 August, so I'll start calculating from July going down. Oh, it was sold on 31st August, so I'll start calculating from August going down. So it differs between when they say an asset was bought, you calculate from the month going forward. But when they say an asset was sold, you calculate from the end, the month that it was sold at going backwards, because of you want to calculate the months where the asset was still working inside the company, where the asset was still available inside the company. So this is the cost method. So the cost method is a bit straightforward, guys. You just know, oh, it's cost times rate over 100 times T over time. So, and then we have the diminishing balance method. The diminishing balance method, it says cost minus accumulated depreciation times rate over 100 times T over 12. So this on its own, cost minus accumulated depreciation, gives us carrying value. So meaning the diminishing balance method, you can also write it as carrying value times R over 100 times T over 12. So don't be confused, guys. T stands for time. T stands for time. So don't be confused and be surprised with why is he writing T? No, T stands for time. So let's go back to the transaction and let's read again what they want from us. So they say, number one, vehicles are depreciated at 20% per annum on diminishing balance method. So on that formula that I just showed you, you already have rate over 100. So this is the rate. The rate is given here, so we don't have to stress about the rate. The rate is given here, so we don't have to stress about the rate. So we already know that when we get to our formula, obviously our R is now 20% over, is now 20 over 100. So we are down about that. And then we read again, we go to our main adjustment. It says an old vehicle, an old delivery vehicle with a carrying value of 170,000. So listen to this statement. It says this vehicle had a carrying value of 170,000 on 1 March 2021. So let's go back. It says this vehicle on this date here, it had a carrying value. It had a carrying value of how much? 170, let me just look, it's 170 what thousand? Of 170, of 170,000. So on that date, 1 September, it had a carrying value of 1 March, it had a carrying value of 170,000. So this is the carrying value. And if you remember very well, they said vehicles are depreciated at 20% using the diminishing balance method. So we already know that, oh, because of we're using the diminishing balance method, we need a carrying value, or we need cost, and we need the accumulated depreciation for the asset so that we can get carrying value. But because of we are lucky enough, according to this activity, they already gave us the carrying value. So we already have our carrying value. So on the formula, we already have this. We already have the R. The only thing we are left with now, it's the time. So you see, when you calculate depreciation, the only thing that they will try to trick you with during an exam time, it's the time, because of they know the formula does not change. You know, cost minus accumulated, it gives you carrying value. The R must be given, only the time will not be given, because of there will never become an activity whereby they don't give you the rate of the depreciation. So you don't have to stress about the R, you don't have to stress about the cost and the accumulated depreciation or the carrying value, because of if you're given cost and accumulated depreciation, you just say cost minus accumulated depreciation, and then you'll get your carrying value. So we already have our carrying value of 170,000 times the rate is given at 20%. The only thing now we are going to calculate is the time, the period. It's the period. So let's go back and see when was it sold. So they say a carrying value of 170,000 on 1 March was sold for 140,000 on 1 December 2021. So it was sold on 1 December 2021. So let's go back to our calendar. So it was sold here. Here, sold 1 December 2021. I said, Mina, after explaining this, I said, remember, when they say sold, you calculate from the month of sale going backwards. When they say purchase, the month of purchase going backwards. But you also consider the rules, whether it is the first or it is the 31st of the month. You also consider that whether it's the beginning of the month or it's the end of the month. So in this case, they said 1st December. So meaning the asset was only available for March, April, May, June, July, August, September, October, November. So it's how many months? It's 1, 2, 3, 4, 5, 6, 7, 8, 9. So already we have time now, 9/12. So we don't have to stress about anything. Now we have time. It's 9/12. And then now we can hit our calculators. I hear an unmuted mic. Hello, do you want to ask something? Guys, I got 25,500. Did you also get 25,500? If you got 25,500, please give me a thumbs up, please. Give me a thumbs up if you got 25,500. Okay, guys. So, remember, we haven't answered the question, ne? Remember, guys, we haven't answered the question because the question was we have to calculate the loss or the profit or loss on the sale of assets. So what have we calculated as yet? This is the depreciation for the year. This is the depreciation for the year. For which asset? For the asset that was sold. So this is sold. It's the depreciation for the year for the asset that was sold. So now we have to find the carrying value at the end of this year for that asset, because of 170,000 was the carrying value at the beginning of the year, was the carrying value for this asset at the beginning of the year. Now we have to find the carrying value for this asset at the end of the year. So now what we do is we say 170,000 minus 25,500. we'll get the carrying value at the end. So our carrying value is 144,500. So this is the carrying value at end. So this was the carrying value at beginning of the year. So you see the difference. The carrying value at the beginning of the year, it has no depreciation accounted for. So, and then we accounted for the depreciation for the months that it stayed for this financial year. And then we left that depreciation to get the carrying value for this current year. So now we have to compare. Now it says the carrying value is the value of the assets at the end of the year. So meaning our asset is now valued 144,500. But let's check how much did we sell it with. Let's check how much did we sell it with. So they say it was sold for 140,000 on 1 December 2021. So our selling price, our selling price, it was 140,000. It was 140,000. So now we have to compare. We go to, okay, what is the value of our assets and how much did we sell it with? So the value of our asset is 144,500, but Tina, we sold it 140,000. So now we say 140,000, 144,500, which is the current value of our asset minus our selling price, which is equals to 45, is equals to 4,500. So 4,500 is the loss on sale of asset. So some of you may ask yourself, why is it a loss? How do you see if it's a loss? So if your asset is valued at a price that is more than what you sold it for, so it means you made a loss. So for example, if you have shoes that are worth 2.5, and then when you sell them in 2,000, so you've made a loss of 500 because of your shoes are worth 2.5, and when you sold them below their worth. So we sold our assets below its worth. So that's why we made a loss of 4,500. So let's go to question 1.2.2. It says calculate the total depreciation for the year. And then let's go to our depreciation. It says equipment is calculated at 15% per annum on cost. And then it continues and says the bookkeeper calculated the total depreciation as 328,200 before taking into account the following. Taking the following into account. So it says equipment. It says an alarm system costing 48,000 was installed on 1 August. Let's go back to our calendar. Equipment. So it says an alarm system costing, let's just write our calendar very fast. March, April, May, June, July, August, September, October, November, December, January, February. So it says an alarm system costing 48,000. It's costing 48,000. So we already have our cost, and we saw that our rate is 15%. 15% per annum. So you see, guys, your cost is given, your rate is given. So we have to calculate, okay, how long did it stay? So we have to account for that time and for that period, depreciation for that period. So it says it was bought on 1 August. On 1 August. It says it was bought on 1st of August 2021. So meaning from August, the asset was there. So from August 1, 2, 3, 4, 5, 6, 7. So it stayed inside the business for 7 months. So times 7 over 12. 1, 2, 3. So times 7 over 12. So we hit our calculators now. We say 48,000 times 15, which is our rate over 100, times 7 over 12. And then our depreciation for the equipment is 4,200. So remember the question said the accountant calculated depreciation of 328,200. Said calculated a depreciation of 328,200 before taking into account the following. So what was left was the depreciation of the sold vehicles and the depreciation of the bought equipment. So we already calculated the depreciation for the vehicle, the sold one. And then we just calculated the depreciation for the equipment, the new one, the new equipment. So what we have to do now is just add everything, 328,200. We add the ones that were not taken into account, plus 25,000 plus 25,500 then, yeah, plus 25,500. And then we see how much is our total depreciation. So our total depreciation is 359,900. Guys, did you also get 359,900? Or 357, not 359, 357,900. Did you also get 357,900? If you got 357,900, raise your hand, please, or give me a thumbs up, please. Okay, guys, before we go to the main question, which is complete the following for the year ended 28 February 2022, is there anything you want to ask? Is there anything you don't understand? You can unmute your mics, guys. There's not a lot of you here, so you can unmute your mics. We will not get disturbed. Hello, guys. Guys, you can unmute your mics. Before we go back, do we go to the main question, which is the statement of comprehensive income? So let's go to the main question, which is the statement of comprehensive income, 28 marks. So there are things that we are going to record on the statement of comprehensive income that we already calculated. For example, we already calculated the loss, the stock damaged. We already calculated the loss on sale of assets, and we already calculated depreciation. So let's do the transactions one by one. So Roman figure 3, it says, Roman figure 3 says, um, 33,700 received from a debtor whose account was previously written off as irrecoverable was posted in error in the debtor's account. This must be corrected. So, okay, guys, this is how it goes. So, for example, if you owe a business, né? If you owe a business until a business decides to write you off, so the business takes you out of their debtors. So the business, it means it writes you off and it does not expect anything from you. So meaning you will not appear as a debtor in the next financial year if they wrote you off in the previous financial year. So even if you pay them back, they cannot go and record in their debtors control account because of you do not appear anymore. So here, the mistake that was made that we need to correct is that they recorded this on the debtors control account as if the person was still expected, was still a debtor that has not been written off, was still expected to pay. Remember, guys, someone who has been written off is someone that the business says, no, we give up on this person. This person is no longer going to pay us. Or this person has no longer got the power or the ability to pay us. So we just have to write them off. So when you come back and pay the business will not record that amount on the debtors control account because of you were written off and you do not appear on the debtors control account anymore. So this is what we must do. So sorry about that, guys. So this is what we must do. We must reverse the what they recorded. So our debtors control account is 2,730,046,300. So our debtors control is 2,746,000. 2,746,300. 2,746,300. And then we have to add because of they subtracted the 33,700 and they shouldn't have subtracted it because of this person was written off and we no longer have him in our books of debtors. Kumbule, remember guys, with the debtors control account, that's where our debtors are. So we no longer had the person, whoever it is, we no longer had the data on those books because of we wrote them off because we knew that they were not able, they were not going to be able to pay. So we wrote them off, and then now we need to add back 33,700. Why do we have to do that? It's because of we minus 33,700 on our debtors control account, which was a mistake because of this person is no longer in the books, in the debtors control books. That person was written off. So you will add 2,746,300 plus 33,700, which will give you 2,780,000. So once you get the 2,780,000, that's your correct debtors control account. Now we continue with the transaction. It says the provision for bad debts must be then adjusted to 3% of the debtors control account. This is what we do. We say times 3/100. We get 83,400. And then after getting 83,400, we have to go and compare with the debtors control that appears on the extract from the balance sheet. So our provision for bad debts is 85,840. And then our provision for bad debts at the end of the year, it's 83,400. So what does it mean? It means that we saved more, we provided more. We thought, oh, in this financial year, the people who are not going to be able to pay us will amount to 85,840. But after calculating, we found out that the people who are not going to pay us amounted to 83,400, meaning we saved more, we have changed, meaning this provision for bad debts will be provision for bad debts adjusted and will be recorded under the income sections in the income statement. It will not be recorded under expenses, it will be recorded under incomes because of we saved more, and at the end of the year, we calculated and find out that after adjusting our provision for bad debt, it is 83,400. Let's see how much we were going to record. So we were going to say 85,000, 85,840. It's 85,840. 85,840 minus 83,400. And we're going to get 85,840 minus 83,400. It's going to be 2,440. So this is our provision for bad debts adjusted, 2,440. And then we continue. Next adjustment, guys. The next adjustment says the business signed a contract with Always Safe Securities for guarding the premises. An annual premium of 32,400 for the period ended 31 July 2022 was paid in full on 1 August 2021. So these questions are, you usually get these questions, maybe you usually get these questions through adjustments, insurance and advertising. So in this case, they only changed the name. It's now it's securities. So this is what you will do, guys. So your calendar year does not change. Your financial calendar year does not change. So your financial calendar year is always from March to February if the end is February. If the end is June, it's from July to June. If the end is September, it's from October. It depends if the end is August, but it does not change because of, you don't change it because of an adjustment. So you don't see an adjustment that says an annual premium ended 31 July 2022 was paid in full on 1 August 2021. And then you think that, oh, now I have to change my financial year, now has to start on August and end July. No. You have to check, what does the transaction say? Does the transaction say the amount was paid? Does it indicate whether the amount is already included in the amount that is shown on the balances and totals from the records of 28 February 2022? So that's what we have to change. So why do we have to look at that? So we have to look at that because of, number one, you have to know whether you have to include or you have to exclude. So the annual premium, you can see it starts from 1 August. Let's do it. It starts from 1 August. So our year does not change, as I've said. So our year is still March, April, May, June, July, August, September, October, November, December, January, February. So it's still 2021 here, 21 here, 22 here. So, but the adjustment said it was paid in full from 1 August 2021. So it was paid here in full. So it was paid in full from 1 August 2021 to 31 July 2022. But Tina, remember, our rules do not allow us to go beyond the financial year. So our rules, you know the rules, guys. It's only we only record for 12 months. We only when you're doing a statement of financial position and statement of comprehensive income, you record for 12 months. So we have, Tina, we have to account from August, September, October, November, December, January, February. And then all those months that are left, we have to exclude them. So they said it's an annual premium. Annual means 12, so we have to say 32,400 divided by 12. Why are we doing this? We're doing this to find our monthly premium. So our monthly premium will be 2,700. So this is the amount we pay every month. So they said the business signed a contract with Always Safe Securities for guarding the premises. An annual premium of 32,400 for the period ended 31 July 2022 was paid in full on August 31, on 1 August 2021. So meaning this this 32,400 is in full is already included in this amount. So this 72,500 already has the 32,400. So what must we do now? We have to remember, Tina, we only account for 12 months. So our financial year ends when? February. It ends here. So whatever months that are here, we can write them, but we don't have to record them. So we have March here, we have March again, April, May, June, July. So you can see good, we have 5 months extra. 1, 2, 3, 4, 5. So now what do we have to do? We have to say 2,700 times 5 is equals to 13,500. So this 13,500 is the amount that we do not have to record. So this is how you're going to write it on the statement of comprehensive income. This is how you're going to write it. You are going to write 72,500, 72,500 minus 13,500, which you'll get 72,500 minus 13,500. You get 59,000. So this is the amount you were going to record. Okay, let's go to the next transaction, guys. So the next transaction is salaries and wages. So it says all details in respect of the February 2022 salary of an employee were incorrectly debited to the sundry expenses account. The following information relates to his salary. So before you write the salaries adjustment, the first thing you have to do, you have to go back to your balances and check whether they set salaries and wages, including contributions, because of sometimes they want you to separate salaries. They want you to do salaries and wages, and you also do contributions separately. But in this case, they said salaries and wages, including contributions, meaning we're going to add everything here. Even the contributions are going to be added here. So the first thing you must know is that when you record salaries and wages, you record the gross income. So never mind the separation they'll do for you. They'll say net salary, SARS pays pension fund, when you have to record the gross income. So you have to take it back. Before it goes to net salary, what happens? You say gross minus salaries and wage, minus SARS pays you in, and then minus pension fund. And then that's where you get net salary. So the only thing you have to do is to go up. You say net salary plus SARS pays you in plus pension fund, and then you'll get your gross salary. So let's do it, guys. So you say net salary 11,525 plus 3,235 plus 990. So this is our gross salary. What we're gonna get here is our gross salary. So our gross salary is 15,750. We would be done if they did not say including contributions, but now we have to account for contributions and we have to read the transaction for the contributions. They say the business contributes 2 rand for every 1 rand deducted for pension fund. Meaning when you take out 1 rand, the business gives you 2 rand. So meaning whatever amount you got, you have to times it by 2 because of the business gives you 2 times of what you issued out. So where now you contributed, you said my pension fund is 990. So the business is going to times it by 2 because of it gives you 2 rand for every 1 rand. So I'm gonna say 990 times 2. 198. And then they say EFT payments has already been made and processed for all relevant amounts payable. And then this is how you are going to record on your statement of comprehensive income. 15,750 plus let's go to plus 1,381,500 plus 1,381,500, 1,381,500 plus the pension fund, which is 1980. And then you get what you have to 1 million. Plus 15,750 plus 1,980, which is equals to 133 1,336,280. 1,336,280. So that is what you are going to record on your statement of comprehensive income. And then we continue, we go to Roman figure 6. It says we're doing rent, Roman figure 6. It says a tenant has been leasing office space on the premises since March 2020. She has paid the rent until 30 April 2022. Note that the monthly amount was reduced by 1,350 with effect from 1 January 2022. As I told you that you don't change your financial year calendar just because of they speak about other years. You always stick to your financial year calendar and then you account for that financial year calendar. What you have to reduce, what you have to remove, you'll remove if it does not belong to that 2022 financial year calendar. So it says the tenant has been leasing space from March 2020, meaning from March 2020 to February 2021, they recorded everything is fine. Now, Tina, we have to record from March 2021 until February 2022. So we say March, April, May, June, July, August, September, October, November, December, January, February. We have to end here. But here's the thing. They said the tenant paid rent until 30 April 2022, meaning the tenant paid for March 2022 and April 2022. March 2022, April 2022. Notice that the months that are out of our financial year calendar, I wrote them with a different color. It's because of I want you to know that we have to subtract them. We have to always account for 12 months. We don't account for more than 12 months. We have to stick to 12 months. So this is what you would do. They say the rent decreased by 1,350 with effect from 1 January 2022. So from here, it's 2021, March, April, May, June, July, August, September, October, November, December. So January, the rent was decreased by 1,350. So meaning from here, the rent was whatever amount it was minus 1,350. So now we have to calculate the months that did not the months that oh I don't want to say it wrong. Now we have to calculate the months that are less than with 1,350. So the months that where the effect of reduction starts from. So the effect of reduction starts from January, February, March, April. So it says January, February, March, April. So we have 4 months that are affected with reduction. So we have to say times 4, and then we have so 5,400. Total reduction for the whole month from the effect. So from 1 January to 8 April, the effect of reduction total is 5,400. So we go back, we have to go and find our rent. So our rent income is 183,600. So our rent income is 183,600. But remember, this rent income has an effect of minus 5,400. So for us to get the rent per month, we have to take it back to the original. So how do we take it back to the original? Because of it was reduced by 1,350,000. Now we have to add back those 1,350,000. So how many 1,350,000 do we have to add back? We have to add back January, add back February, add back March, add back April. So we already times by 4, which gives us 5,400. So we'll add back 5,400 and see how much was the total rent before reduction. So we have 183,600 plus 5,400. So this was the total rent before the reduction, 189,000. 189,000. Now we know that each and every month has a fixed rent now. It has a fixed rent. Every month is equal to another. So we have to calculate our months from March until April to see how many months did we pay. So from March to April, it sums up to 14 months. So we paid 14 months. So we have to say 189,000 divided by 14. And let's see how much we get. So this is our rent per month before reduction. So our rent per month before the effect of 1,350 is 13,500. Now we have to do the effect. So, but there's only 2 months that we do not want. So we don't have to do the effect for 4 months because of we know the 2 months, January, February is already recorded. March, April is also already recorded, but we want to exclude March, April. So you just say 13,500 minus 1,000 minus 1,350 then you get minus 1,350. You get 12,150. And then you have to say 12,150 times 2. Why do we have to times by 2? It's because of it's the 2 months that we do not want. It's March and April 2022. So we have to times it by 2. Let's see how much we get. 24,300. So this is how we were going to record on your, this is how you're going to record on your statement of comprehensive income. So you're going to say 183,600 minus 24,300. You get 183,600 minus 24,300. You get 159,300. So this is what you get. So Kagiso, can I get a thumbs up if you are still with me and if you still understand? Can I please get a thumbs up if you are still here and you still understand? Are you still here? Kagiso? Okay. Question? What's your question, Kagiso? I can see your hand is ready. What is your question? Hmm? Or you don't have a question, you just raised your hand to show that you're still here. Okay, okay, Kagiso, let's continue. Let's continue. Now we'll do income tax at the end. We'll treat it as our last transaction. So let's continue. Let's continue to loan. So they say loan certain bank. They say all transactions with respect to the loan were recorded. Interest of 142,250 on the loan was capitalized. So that's the interest that is capitalized. A fixed monthly premium, including interest, was paid in full. Okay. They say the capital portion of the repayments will increase by 10% over the next financial year. So, okay. Here we have to calculate our long-term loan and our current portion. So we have to calculate our non-current liabilities and our current liabilities in terms of a loan. So here's our loan. They tell us, they say 2021, at the beginning of 2021, beginning of our financial year, we owed 1,280,000, 280,750. That's what we owed at the beginning of 2021. And then they say at the end of 2022, at the end of our financial year, we owed the bank 1,159,000. So, meaning there's an amount we paid right there. There's an amount that we paid right there. So now we have to calculate our the amount that we paid and our current portion. Okay. 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 It says our loan was at the beginning of the year, it was 1,280,000. And then at the end of the year, let's write. I don't want to miss this. 1 million. It's 1,280,750. 1 million, 1,280,750. And then minus 1,159,000. So minus 1,159,000, which is equals to 1,280,750 minus 1,159,000 is equals to 121,000. This thing just, sorry for that. This thing just made me start again. So it's at the beginning of the financial year, we owed the bank 1,280,750. At the end, we owed the bank 1,159,000. 1,159,000. So meaning we paid 1,121,750. That is what we paid, guys. So let's go back to our transaction and see what they say. They say a fixed monthly installment, including interest, was paid in full. Okay. And then they say the capital portion of the repayments will increase by 10% over the next financial year. So this is the capital portion, the 1,221,750. This is the capital portion. And it will be increased by 10% over the next financial year. So now we have to account for the increment. Say 110 over 100. And then it gives us, let me calculate. Gives us 133,925. Do you guys get that? Do you understand, Kagiso? So this is our current portion of the loan, the 131,000, the 133,925 is our current portion loan. So that's our current portion loan. So now we have to calculate the non-current, the mortgage loan, which is teachers call it the mortgage loan, the non-current portion of the loan. So this is how you calculate your non-current portion of the loan. You say 1,159,000 minus 133,925. And then you get 1,025,075. So you get 1,025,075. Okay. We're about to finish, Kari, so hang on there. So your 1,025,075 would be your would be your mortgage loan. So this is how you would record on the equity and liability section of your balance sheet. Under non-current liabilities, mortgage/mortgage loan, you'd say 1,159,000 minus 133,925, which is equals to 1,025,075. So your current portion, this is how you would do it. You say at the beginning of the year, we owed the bank 1.2 million, 1,280,000 and 750. And then at the end of the year, we owed the bank 1,159,000. So we wanted to check how much did we pay. So we said 1,280,000 and 750 minus 1,159,000, which gave us 121,750. And then the transaction said the capital portion of the repayments will increase by 10% over the next financial year. So we had to increase it by 10%. We increased it by 10%, and then we got 133,925. So now we go to the next transaction. So our next transaction is shareholders, shares, and dividends. It says on 28 February, there were 1,150,000 shares in issue. A final dividend was declared on 28 February 2022. The total dividends for the year amounted to, and then they tell us the total dividends, which is 345,000. So we're gonna use the information to calculate our retained income, because we need retained income in our equity and liability section of the balance sheet. And we also we're gonna use the information to calculate our shareholders for dividends. So let's go to our retained income. So you can see the only thing we are given here is ordinary share capital. And if you think very well, you know very well, if you add ordinary share capital and retained income, you get your shareholders for equity. So let's go back to our transactions. The adjustment number 10. It says, after taking into account all adjustments, the net asset value was correctly calculated as 675 cents per share. Ne? So in this transaction, what we need to do for us to find our retained income, we need to use the net asset value, the shareholders capital. Wait, my screen is giving me a problem. Oh, okay, thank you. So we have to use ordinary share capital. We have to use retained income, which is it's a question mark. We don't have retained income. We have to add ordinary share capital and retained income, and then we divide it by the number of shares, total number of shares in issue, and then times it by 100 equals to the 675 cents. So the first thing we have to consider in our minds is that our NAV, the formula for NAV is shareholders equity all over number of shares. in issue all over number of shares in issue times 100. It will give us something cents. So shareholders' equity is made out of retained income plus ordinary share capital, and then divided by the number of shares times 100 equals to something something cents. So I want us to write down what we already have. So we're gonna need a bigger space. I want us to write down what we already have. NAV. What we already have. So what we already have is our ordinary share capital, which is 6,670,000. We have to add it with our retained income, which is our retained income is an unknown, is an X right now. So our retained income is an X right now. Because if we don't know, we are looking for that retained income. Times 100. And we already know the number of issued shares. It's 1,150,000. So we already know how much is our NAV. So our NAV is 675 cents. So our NAV is 675 cents. So now we have to find our retained income. Okay. Quite a few methods you could use here. So you could just decide to make 675 cents into 6 rand 75 cents, and then remove the 100 here, and then you'll still be able to get it. But I like the longer method. I like the longer method. I think it's better, and people understand better. So the longer method, you will see huge figures, guys. Do not be surprised. You will still get to the original retained and correct retained amount. So it says 600 and so you'll say 100 times 6,670,000, which will give you this huge amount, 6,670,1, 2, 3, 4, 5. So it will give you this huge amount. So you'll say 100 times X, and then it's over 1 here. You'll say 100 times X, which is 100X. And then you still have all over 1,150,000 equals to 675. And then you cross multiply over 1, this and this. And then you say 6,670,000 plus 100x is equals to 7,762,5,0,0,0. So you can see, as I already told you, that you're going to get huge values. So don't worry. The values are going to go back to the normal values that you are used to, go back to millions. So, and then now you do your math. You do your solve for X. You transpose. Hundred X. And you say all of this divided by 100, and all of this divided by 100. And then you'll get your X as 109, 1,092,500. So you see, guys, we still got the values that we are used to. We still got millions. So this is how you do it, guys. This is how you reverse your NAV, and this is how you get uh, the retained income. It doesn't matter, guys, whether you are given retained income or or ordinary share capital. It doesn't matter. You still do the same thing. Whether you're given retained income or you're given ordinary share capital, you still do. If you're given the NAV, you still do the same. You still do the same thing, guys. So I think this was the last question. This was the last adjustment of our question today, guys. Thank you, guys. Thank you very much. So we're gonna meet again. Thank you very much. I'm closing the